On January 30th, 2026, the precious metals market suffered a Black Friday. Spot silver in London plunged 26.42% at the close, down more than 36% intraday, while spot gold fell 9.25%, marking a rare multi-decade drop. At the heart of the crash was a simultaneous retreat of financial speculation and exposure of fragile industrial demand, highlighting the inherent conflict in silver's dual nature and its supply chain woes. The collapse was triggered by three converging factors: Trump's nomination of Kevin Warsh as Fed chair, which erased expectations for aggressive rate cuts, causing safe haven premiums to evaporate and capital to flee. Severe overbought conditions: gold had gained over 20% in January, silver over 80% in 6 months, combined with silver's thin liquidity, triggering a technical long squeeze and stampede. And finally, stronger than expected U.S. core PPI and the resolution of a government shutdown crisis, which revived inflation concerns and risk appetite, further dampening demand for precious metals. Silver fell much harder than gold due to its fragile industrial role and inflexible supply chain. 55% of industrial silver demand comes from photovoltaics, PV, where it accounts for 19.3% of panel costs. Soaring prices accelerated a silver thrifting shift in PV, creating a paradox where higher prices destroy demand. Meanwhile, 71.7% of global silver supply is a byproduct of copper, lead, and zinc mining. Supply can't quickly respond to price signals. Long mine expansion cycles and prices now crashing below production costs for many miners further limit supply elasticity. Inventory data also exposes a disconnect between paper trading and real physical demand. Precious metals are likely to move in phases. Short-term, 2 to 3 months. Choppy bottoming, with 30 on Oz silver and $4,700, $4,800 Oz gold as key support. The gold-to-silver ratio is elevated, and silver remains more volatile. Medium-term, 3 to 6 months. The rebound scale will depend on the race between PV silver thrifting and new installation demand. Long-term, 6+ months. Currency debasement fears and central bank gold buying will support the sector, but silver's weakening industrial demand will cap its gains. Investing should follow the principle of avoiding risk, watching ratios, and monitoring the industry. Don't blindly buy the dip, and strictly control leverage. If the gold-silver ratio breaks above 90, consider tactical silver allocations for a bounce. If it falls below 70, favor gold. Within the supply chain, focus on silver byproduct miners, but be cautious about PV silver paste firms facing long-term technological substitution risks. This crash serves as a market wake-up call. Silver's vulnerability stems from its rigid supply chain and a fundamental shift in its demand structure. For ordinary investors, controlling leverage and adopting a cautious wait-and-see approach remain the core strategies to navigate the current risks.